This episode is for general education only. It is not investment, tax, legal, immigration, or financial advice. Please consult your CPA, financial advisor, immigration attorney, or tax professional before making decisions based on your personal situation. Many H1B professionals live with a strange kind of uncertainty, almost anxiety. They're building careers in America. They're paying US taxes, they're renting apartments, their kids may be going to school here, their entire life may be in the United States. And yet, somewhere in the background, one question keeps running. What if I never get a green card? What if I have to go back to India or whatever their home country is? What if I build everything here and then suddenly have to leave? Now, this is not a theoretical concern. For many immigrants, especially from India, the green card backlog can feel endless. So people start making decisions not based on what is best financially, but based on fear. And in some of those decisions can be very, very expensive. Now, one of the biggest decisions is this. I should not invest in 401k or IRA because I may have to leave the United States. At first glance, it sounds logical. Let's say you're on H1B. You think, maybe in 3 years, I'll have to go back to India. If I put money in 401k, then when I leave, I'll have to withdraw everything. If I withdraw before 59 and a half, then IRS will penalize me. So why bother? Now that fear is understandable, but the conclusion may be wrong. The IRS generally treats withdrawals from qualified retirement plans before age of 59 and a half as early distributions, and those may be subject to a 10% additional tax unless an exception applies. Now that part is real. But here is the part many people miss. Leaving the United States does not automatically mean you have to liquidate your 401k, IRA, brokerage account, or bank account. Your money does not get confiscated because your visa status changed. You do not have to be physically sitting in California or Texas or New Jersey for your retirement account to keep existing. In many cases, you can keep your US retirement account even if you move abroad. But there is an important practical caveat. Banks and brokerages have their own compliance rules. Some may restrict trading, limit certain services, or have issues with foreign addresses. So before you leave the country, you should check directly with your provider and understand their rules. But the basic idea is important. You may move, but your account may not have to move. And that changes the entire analysis. Now imagine someone who works in the US for 10 years. During that period, they consistently contribute to a 401k. For 2026, the employee contribution limit for many 401k plans is $24,500, with higher limits for people age 50 or older. Now, let's say this person eventually moves back to India or their home country. Instead of withdrawing everything immediately, they leave the account invested in the US. The money remains in the dollars. It remains invested according to the options available in the plan or in an IRA after the rollover, depending on what they choose and what rules apply. Now, years pass. Maybe they are now living in Pune, Bangalore, Mumbai, Hyderabad, or Chennai, but their retirement money is still sitting in the US financial system. Now, think about what they avoided. They avoided converting all of their US dollars into rupees immediately. Now, that can matter a lot. Historically, the Indian rupee has depreciated significantly against the US dollar over long periods. For example, Federal Reserve data shows that annual average exchange rate was about 43.5 rupees to 1 US dollar in 2005 and about 87.1 rupees to 1 US dollar in 2025. At the time of recording this, it's 96 rupees to 1 US dollar. Now, that does not mean rupee will depreciate at the same rate in the future. Currency movements are not guaranteed, but the long term pattern matters. If you move money from dollars into rupees too early, and then rupee weakens over the next 10, 15, or 20 years, your purchasing power in your dollar terms may suffer. This is where many immigrants make mistakes. They think only question is, what happens if I leave? But the better question is, what happens if I leave and still keep some assets in dollars? That is a very different question. Because if you go back to India and keep part of your wealth in US retirement accounts, you may still benefit from dollar denominated assets, US market exposure, and a long term compounding. And remember, contributing to your traditional 401k can also reduce current taxable income, depending on the type of contribution and your tax situation. For a high income professional, the tax savings from the contributions can be meaningful. You're not just investing, you may also be reducing your current tax bill. So when someone says, I won't contribute to my 401k because I may leave the country, they may be giving up three things at the same time. They may be giving tax benefits, they may be giving up years of compounding, and they may be given an advantage of keeping part of their wealth in US dollars. That is big price to pay for uncertainty. Now, let's move to the second major decision. Real estate. Many H-1B professionals also hesitate to buy home. Again, the fear is understandable because they think, what if I buy a house and then have to leave in 3 years or maybe suddenly? And what if the market is down when I'm leaving? What if I'm forced to sell at the wrong time? Now, that is a real risk. Real estate is not like selling a stock. You cannot click a button and liquidate a house in 5 seconds. There are agents, inspectors, repairs, appraisals, buyers, lenders, contingencies, and closing timelines. So yes, buying a house when your immigration situation is uncertain requires caution. But again, the question is not just, what if I have to leave? The better question is, what are my options if I have to leave? Now, one option is to sell. If the home has appreciated, or if you simply want a clean exit, selling may make sense. Another option is rent it out. This is where many people underestimate how real estate works. You do not necessarily need to personally fix toilets, collect rent, and answer tenant calls from India at 2 a.m. You can hire a property management company. A good property manager can market the property. You can market the property, screen tenants, collect rent, coordinate repairs, handle tenant communication, and send you monthly statements. And you as an owner can make decisions remotely. Now, does that mean it's completely passive? No. Owning a rental house is never completely passive. You still have to risk, you still have repairs, you have vacancies, you still have insurance, taxes, mortgage payments, and if the property does not cash flow, you may have to send money from India to support the US property. Now, that may not be attractive. So the math matters. If rent covers mortgage, taxes, insurance, maintenance, and property management, keeping the house may be a very reasonable option. If the property is deeply negative every month and you do not want to keep funding losses in US dollars while living abroad, selling may be better. But the point is this: you're not automatically trapped. A house does not become worthless because you leave the country. You can sell it, you can run it, you can hire management, you can make a decision based on the market condition instead of panic. And yes, in some situations, speed matters more than price. There are investors and cash buyers who can close quickly. That may not get you the highest possible price, but it is an option. The existence of that option matters because it reduces the feeling that you are completely stuck. Now, there is a third path as well, which is passive real estate investing. This could include things like real estate funds, private syndications, REITs, and other structures depending on your goals, risk tolerance, accreditation status, liquidity needs, and tax situation. The appeal is simple. You get exposure to real estate without personally owning and managing a house. In a syndication, for example, you're typically a passive investor. The sponsor or general partner handles acquisition, financing, operations, property management, reporting, and eventual sale or refinance. You do not need to live near property. You do not need to meet tenants. You do not need to call plumbers. You invest, receive updates, review tax documents, and wait for the business plan to play out. Of course, passive does not mean risk free. Syndications may lose money, they're often illiquid. You may not be able to exit whenever you want. The operator matters, the debt matters, the market matters, the documents matter. But for someone who is worried about leaving the United States, passive real estate can solve one specific problem. You do not need to be physically present to manage the asset. If you move back to India or whatever your country is, your investment does not require you to drive to the property on Saturday morning because the water heater failed. And that's the point. Physical relocation does not automatically destroy the investment thesis. This brings us to a larger lesson. Do not stop investing just because your immigration situation is uncertain. Uncertainty should make you more thoughtful. It should not make you financially frozen. If you are an H-1B, it is very easy to live in a temporary mindset. Temporary apartment, temporary furniture, and temporary plans, temporary financial life. But then 5 years pass, then 10 years pass, and you realize the temporary life was actually a big part of your prime earning years. And if during those years you avoided 401ks, avoided investing, avoided real estate, avoided long-term planning, and kept everything in a checking account because I might leave, the cost can be enormous. The US remains one of the deepest financial markets in the world. Foreign investors continue to put large amounts of capital into the United States. For example, the Bureau of Economic Analysis reported that the foreign direct investment position in the US reached 5.71 trillion, the trillion with a T, at the end of 2024. The goal is not to let the uncertainty quietly steal 10 or 20 years of compounding from you, because one day, whether you are in Los Angeles or London or Mumbai or Bangalore, your future self will not care whether your fear was understandable. Your future self will care whether you planned well. And sometimes the smartest move is not to take all your money back home. Sometimes the smartest move is to let some of your money keep working in the country where you earned it, even if you no longer live there. Thank you for listening to the OMC Real Estate Podcast. My name is Vaibhav Puranik. We have many more interesting tips like this on our website, oldmoneycapital.com. Please visit oldmoneycapital.com and click on a request a call button to schedule a call with us. We can tell you more about how syndications work in general and if it's good for you or not. Thank you again.